glad you mentioned the Japan bond correlation, right? And as much as I've talked about the carry trade for the last 2 years, I myself am starting to wonder if it's almost too publicized, and maybe we see yields come in quite a bit on the Japan side, which have implications on yields on the U.S. side. So, could we be entering a phase where it's more than just a trade for yields dropping? That maybe we see the exact opposite of what the crowd thinks, which is global yields starting to drop.
Everybody wants to ignore, like, it's perfectly reasonable for US investors to ignore the rest of the world's stock markets because they have no really important companies. We have all of them. So we have the Magnificent Eight, which includes Broadcom. That really dominates the global capital market. So feel free to completely ignore everybody else's equity market. Do not ignore their bond markets. Bonds are fungible. We don't have like a Broadcom of bonds. Our bonds are similar, basically zero default risk to UK bonds, Deutsche, German bonds. So when the ECB cuts, you can say, well, I don't care the ECB cut. Well, you should, because you're injecting liquidity into the global capital markets, because that's what you need to do to cut rates, is to put more money in the banking system. And then that flows into capital markets and it lowers global rates. Now, Japan had actually been tightening, shrank their money supply by almost 4%. And so that's the only place in the world where it's an offset, and it kind of melted down quickly. And you saw that dislocation. But we believe maybe it's not this month, maybe it's the following month, but the Fed should be looking at claims which are clearly rising. And because that's a leading indicator, I always want lagging indicators. And they should be cutting. When they'll figure out, not out exactly, I don't know, but we do think it's this year. Noise will pass in the next month or two. So we think that the Fed, as usual, is behind the curve and we'll figure it out.